Hi everyone, my name is Muhammad Najmi bin Muhammad Nasir. Today, our group will be present the financial statement MFRS101. Before we start, let me introduce our group member. Shabrina, Adilah, Zakira, Ain, Farah, Dalila, Atira, Anas, and it's me, Najmi. For the introduction, Financial Reporting Standard 101 Presentation of Financial Statement replaces FRS 101 Presentation of Financial Statement revised in 2005 as amended in 2008. FRS 101 sets overall requirement for the presentation of financial statement, guidelines for their structure, minimum requirement for their content. And for the objective, the main objective of the International Accounting Standard Board in revising IAS 1 was to aggregate information in the financial statement on the basis of shared characteristics. With this in mind, the board considered it useful to separate change in equity of an entity during a period arising from transaction with owner in their capacity as owner from other change in equity. Consequently, the board decided that all owner change in equity should be presented in the statement of change in equity separately from non-owner change in equity. FRS 101 affect the presentation of owner change in equity and of comprehensive income. It does not change the recognition, measurement of disclosure of specific transaction and other event required by other FRS. FRS 101 require an entity to present in a statement of change in equity all owner change in equity, all non-owner change in equity are required to be presented in separate income statement and a statement of comprehensive income. Component of comprehensive income are not permitted to be presented in the statement of change equity. And for the scope, general purpose financial statement are those intended to meet the need of users who are not in a position to demand report tailored to meet their particular information needs. General purpose financial statement include those that are presented separately or within another public document such as an annual report or a prospectus. This standard does not apply to the structure and content of condensed interim financial statement and prepared in accordance with FRS.
What is pre-statement of profit or loss? Statement for profit or loss is a financial statement that summarizes the revenues, the costs and expenses incurred during a specific period, usually quarter or fiscal year. It also provides information about company's ability or inability to generate profit by increasing the revenue or reducing costs, or both. So basically they are using tools such as cash method and accrual basis method lah. And the purpose of the P&L is to show a company's revenue and expenditure over a specific period of time, usually over 1 year. The investor and the analysts can use this information to assess the profitability of the company, often combining the information with insights from the other two financial statements, which is balance sheets and cash flow. The P&L statement is useful for examining trends in your business and understanding where you are bringing in the money and where you're losing it. There are lots of questions that you would ask, which is, are you making a gross profit? If you have more than one revenue stream, how are they performing against each other? Where are you spending most of your money? Are there any big expenses categories you might be able to lower? Your income statement can surface these questions you should ask, and there are potential problem spots to investigate. Besides flagging possible issues, the P&L statements can also highlight opportunities for growth. If a particular area of your business is bringing a lot of revenue, you might consider investing more resources in that area to help it expand. Conversely, if there are any struggling products of business lines, you can consider how to improve them or decide they're just on good fit for your business. As we have attached a statement of profit or loss and other comprehensive income year ended 30 June 2016, the P&L that shows your income, COGS, gross profit, expenses, net operating income and total net income. The first part of the P&L covers income, COGS and gross profit. As we see here, the revenue is that all the money we in from the sales will be listed or broken by the sources. It compares like 2016 is more than 2015. Same goes to cost of goods sold, that is how much it costs the company to create the product or service by its sellings. And the calculation of for the gross profit is total revenue. We have calculated total revenue minus COGS, so the total of the both of these is the gross profit, and also the gross profit of 2016 is more than 2015. As we look here, there are service revenue and other income in this statement. Profit or loss of Techwork Limited. Service revenue is the income that a business generates in return for completing a service. Therefore, here are included that 2016 of service revenue is more than 2015. Other income is income arising from activities unrelated to a company's core business. So also, 2015 is more income than 2015. After the revenue exchange, we have come to the expenses. These are broken out into the categories and subcategories to give a better picture and for spending how much money we spending on. And here are examples, such as we have calculated there are lots of expenses here, including the administration's expenses, the depreciation, amortization, and this is all we have to add up to calculate to get operating profit. Net operating income is one of the most important lines on P&L statement because it shows that what is left over after all the expenses are paid. If the number is positive, it means your business is profitable. If it's negative, however, it means your business is spending more than it brings in the money, and you are burning capital just to stay in business. This is normal for companies like startups, of course, but even if you expect to operate at loss, you still want to keep an eye on just how much you have burning. So, as we all know, all the expenses continued as add up, and 2016 operating profit is more than 2015. As we all know that Techwork Limited in 2016 is more making profit than 2015.
Now, it is my turn to explain more about other comprehensive incomes. So, what is other comprehensive income? Other comprehensive incomes is those revenues, expenses, gains and losses that are excluded from net income on the income statement. It is excluded from net income because the gains and losses have not yet been realized. This means that on the income statement they are listed after net income. Okay, then other comprehensive income includes unrealized gains and losses reported in the equity section of the balance sheet that is needed below retained earnings. For the example, items that may be classified in other comprehensive income can consist of unrealized holding gains or holding losses on investment that are classified as available for sale, pension plans gains or losses, and hedging transaction. In some cases, Other comprehensive income is shown on the balance sheet to alert financial statement users to the possibility of a realized gain or loss on the income statement in the future. Okay, next, I will explain what unrealized gain and unrealized loss is. Unrealized gains and loss happen when an asset's value changes after it is purchased and has not yet been sold. So, an unrealized gain occurs when an asset's value increases after the investor purchased but does not dispose of it. That means the asset's current price is higher than it was when the investor originally purchased it. For example, the stock was purchased for $20 per share and is now worth $35 per share, so the unrealized gain is $15 per share. Similarly, an unrealized loss is the opposite of an unrealized gain. It occurs when the price of an asset decreases after an investor buys it but has yet to sell it. For example, the stock was purchased for $60 per share but ended up selling for $45, so the unrealized loss is $15 per share. So, as we can see, this is an example of other comprehensive income statement. This statement is connected to the statement of profit or loss that has been described by Sabrina. At the end of the statement is the comprehensive income total, which is the sum of net income from the profit or loss statement and other comprehensive income.
Hi, my name is Nur Atrisna binti Mamisov. I will talk about asset in statement of financial position. In financial accounting, a statement of financial position, also known as a balance sheet, is a summary of the financial balance of an individual or organization. Within it be a business partnership, a corporation, private limited company, or other organizations such as government or not-for-profit entity. Asset, liability, and equity are listed as of a specific date such as the end of a financial year. A balance sheet is often described as a snapshot of a company's financial condition. Of the four basic financial statements, the balance sheet is the only statement which applies to a single point in the time of the business calendar year. A standard company statement of financial position has two sides, assets on the left and financial on the right, which itself have two parts, liabilities and equity. The main categories of assets are usually listed first and capitally in order of liquidity. Assets are followed by a liability. The difference between the asset and liability is known as equity or the net asset or the net worth or capital of the company, and according to the accounting equation and net worth must equal asset minus liability. Asset was a part of statement of financial position. An asset is any resource owned or controlled by a business or an economic entity. It is an entity that can be used to produce positive economic value. Asset represents a value of ownership that can be converted into cash. Asset can be grouped into two classes, current asset and fixed asset, or non-current asset or plant property and equipment. An asset has a three essential characteristics. It embodies a probable future benefit that involves a capacity singly or in combination with other assets to contribute directly or indirectly to the future net cash inflows. A particular entity can obtain the benefit and control others' access to it. The transaction or other event giving rise to the entity's right to the our control of the benefit has already occurred. This accounting definition of asset necessarily excluded employees because while they are the capacity to generate economic benefit, an employer cannot control an employee. Similarly, in economics, an asset is any form in which rights can be held. There is a growing analytical interest in the asset and asset form in other social science too, especially in the term of the how inventory of things. In the financial accounting sense of the term, it is not necessary to be able to legally enforce the asset's benefit for qualify a resource as being an asset, provided the entity can control its use by the other means. The accounting quotation is the mathematical structure of the balance sheet. Is related to assets, liability, and equity. Asset equal to liabilities plus capital. Liabilities equal to asset minus capital. Equity equal to asset minus liability. This is the example asset in statement of financial position.
Hi, my name is Nur Zakira and I will explain about the statement of financial position. Financial position is the current balance of the recorded asset, liability and equity of an organization. I hope you understand what my friend explained about the asset. I will explain about the liability and equity. First, we will look into the liability. A liability is something a person or company owes, usually a sum of money. Liabilities are settled over time through the transfer of economy benefits including money, goods or services. The liabilities include loans, account payable, mortgage, deferred revenues, bond, warranties and accrued expenses. Business sort their liabilities into two categories. First is current liabilities and the second one is non-current liabilities. Current liabilities are debt payable within 1 year, while non-current liability are debts payable over a longer period. For example, if a business take out a mortgage payable over a 10-year period, that is a non-current liability. However, the mortgage payable that are due during the current year are considered the current portion of long-term debt and are recorded in the short-term liability section of the balance sheet. Current liability example are unearned revenue, account payable, overdraft bank. For non-current liability, the example are long-term loan and mortgage payable. Okay, now I will explain about the equity. Equity typically referred to as shareholders' equity or owners' equity for privately held companies. It represents the amount of money that will be returned to the company's shareholders if all the assets were liquidated and all of the company debts was paid off in the case of liquidation. How is equity works? Okay, equity works by comparing concrete number reflecting everything the company owes and everything it owes. The asset minus liabilities shareholder equity equation paints a clear picture of company finance that easily interpreted by investor and analysis. Equity is used as capital raised by a company which is then used to purchase asset, invest in project and fund operation. A firm typically can raise capital by issuing debt in the form of loan or via bonds, or equity by selling the stock. Investors usually seek out equity investment as it provides greater opportunity to share in the profits and growth of a firm. Equity examples are common stock, additional paid-in capital, preferred stock, retained earnings, and the accumulated other comprehensive income. Okay, this is the example of equity and liability side on the statement of financial position. Okay, that's all from me. Thank you.
Hello, my name is Muhammad Anwar. Now I will continue to present about changes in equity. So, what is statement of changes in equity? The reconciliation of a company opening and closing equity balance during a detailed reporting period is referred to as a statement of changes in equity. as we know, is explain the relationship between a company income statement, balance sheet, and include all the transactions that not captured in this financial statement. Now, let's take a look at how statement of changes in equity works. Since changes in equity is used to determine the company ending balance, it plays an important role in interim financial reporting. Not only that, it also has a carrying amount at the start and end of each period. This is also not very important of monthly financial statement because not all financial statements are required to be issued. Other than that, this transaction can be found in net profit or loss, dividend payment, effect of higher period error, and effect of changes in fair value for specific asset. Changes in equity are usually presented as a separate statement, but they can also be incorporated into another financial statement. Changes in equity can be separated into four, such as common stock, additional paid in capital, retained earnings, and treasury stock. Now, let's move on to the key factors of changes in equity. The carrying amount of the component of equity, such as share capital, retained earnings, and re-evaluate between the beginning and end of the reporting period, is the key element of changes in equity. The second is an adjustment for the equity account as a result of accounting policy. The final element is an error correction that happened during the period, and necessity and equity account adjustment due to the impact of the period and summary statement. As you can see, this is example statement of changes in equity for Tishword Ltd for the of June 2016. The total equity balance at the end of June 2016 increased by RM162,667. However, there are several large line items within the RM162,667 change in equity that moves equity in different direction. By selling their share to investor, the company share capital increased by RM10,000 in 2016. Following that, the reserve for share-based payment was increased by RM2,795. After paying all direct costs, indirect costs, and income tax, retained earnings increased by 148,883. I think that's all for me. Thank you.
Hi and Assalamualaikum. My name is Farah Eliana and today I'm going to present about statement of cash flow. Statement of cash flow is a report that gives the movement of cash during the period under consideration. It gives an idea about the inflow and outflow of cash from operating, investing and financing activities. Statement of cash flow is a financial statement that summarizes the amount of cash and cash equivalent entering and leaving a company. It is a financial statement that shows how changes in balance sheet accounts and income affect cash equivalent. The cash flow statement measures how well a company manages its cash position, meaning how well the company generates cash to pay its debts, obligation and fund its operating expenses. Essentially, the cash flow statement is concerned with the flow of cash in and out of the business. It is an important indicator of a company's financial health because a company can report a profit on its income statement, but at the same time have insufficient cash to operate. A positive cash flow indicates cash inflow, whereas a negative cash flow indicates cash outflow. The cash flow statement is divided into three categories. First is the operating activities, second is the investing activities, and the last one is the financing activities. Each head signifies the source from where a company can make money. The operating activities on the cash flow statement include any sources and uses of cash from business activities. In other words, it reflects how much cash is generated from a company's product or services. For example, purchases or sales of product increase or decrease in current asset and current liabilities, depreciation and etc. While for investing activities, it includes any sources and uses of cash from a company's investment. In short, changes in equipment, asset or investment relate to cash from investing are included in this category. Other than that, cash from financing activities includes the source of cash from investor or banks, as well as the uses of cash paid to shareholders. A company will look to expand its businesses from time to time. To finance this, the company will either raise equity or debt. There are two methods of calculating cash flow. First is a direct method and the second one is the indirect method. The direct method adds up all the various types of cash payment and receipt, including cash paid to supplier, cash received from customer, and cash paid out in salaries. This method of cash flow statement is easier for very small businesses that use the cash basis accounting method. These figures also can be calculated by using the beginning and ending balances of a variety of asset and liability accounts and assuming the net decrease or increase in the account. It is presented in a straightforward manner, while for the indirect method, cash flow is a way to present data that shows how much money a company spent or made during a certain period, from what sources. It is calculated by adjusting net income by adding up or subtracting differences resulting from non-cash transaction. Non-cash items show up in the changes to a company's asset and liabilities on the balance sheet from one period to the next. Therefore, a company's accountant will identify the increases and decreases to asset and liability accounts that need to be added back to or removed from the net income figure in order to identify an accurate cash inflow or outflow.
My name is Nur Aishwada and I'm going to present about the example of cash flow from Taiwo's Limited Company. So the amount of company that a company earns on its ongoing business activities is called cash flow from operating activities. It indicates the success of a business because it determines the ability of a company to pay for its current liability. So if a company has consistently has negative cash flow from operation, it means that the company has liquidity problems and maybe not be able to continue to operate for a long time in the future. So based on TechWorks Limited Company statement of cash flow from operating activities, it can be said that the company has no problem with the liquidity issue since the total from operating activities is in positive cash flow. For example, the company is quite good in making sales because the money received from customers is quite high. Meanwhile, for the payments also that have been made to the supplier and employee is quite high because the company needs to pay for its liability and the employee benefits expense. Okay, overall everything is okay because the company has sufficient cash to make operating activities operation efficiently. Next, the cash flow spent on non-current assets that are expected to generate profit in the future, we know as cash flow from investing activities. So, sales of investment securities is an example of such activities. Alright, so this cash flow from investing activities, it is very important because it helps the company on how they allocate their money for the long term. Alright, so based on TechWorks Limited's company statement of cash flow from investing activities, it can be said that the company invested a huge amount of money by making payments for property, plant and equipment for $52,779 and they also made payment for intangible assets, right? So the only positive cash flow that has been made in this cash flow is only when the company makes an investment in financial assets. So overall, the company had a negative cash flow from investing activities because they spend a lot of money on new intangible assets and property, plant and equipment. Last but not least, cash flow from financial activities measure the cash movement between a company and its owner, investors, and creditors. So basically, it focuses on how a company raises capital and return it to investors through capital markets. Right? So based on Techworks Limited's company, the highest amount of cash flows in their financial activities is due to dividend paid. Meanwhile, the cash inflow were due to proceeds from borrowings and also shares issue. Although the net cash provided by financial activities is negative, investors and also the market will view it as positive because the company is making dividend payments to increase shareholder value by paying them a dividend. Alright? So, not to forget that cash and cash equivalent at the end of the year, which is $70,070, is way better than previous year, and this is a good sign for the company since it is the most liquid asset, and usually investors consider change in cash and cash equivalent as a reflection of a company's liquidity and solvency.
Hi everyone, so I'm Adele. I am the last presenter for this group. So my topic is about notes to the financial statement. Before that, have you ever looked at any company's annual report? If yes, great. At least you know what is notes about, right? So notes is amendments to MFRS 101 presentation of financial statement. So actually notes are calculations supporting the value on the financial statement and to disclose the information required by MFRS that is not presented as well in the financial statement. Not just that, it is also to clarify further about accounting procedures used by the company. So what notes should be included? First, the basis of preparation. Usually, the first notes in the series explain the basis for accounting, if cash or accrual rules were used to prepare the documents, and the methods used to report amortization or depreciation expenses. Second, summary of significant accounting policies. This is to describe the key policies being followed by the accounting department. Accounting policies are the specific principles, bases, conventions, rules, and practice applied by entity in preparing and presenting financial statements. So, thirdly, notes to disclosure. Notes to disclosure is to tell detail about each item in financial statement. So, as you can see in Techworks annual report, they tell us that they use accrual accounting for basis of preparation. They also state what policies that they use. They clearly state the method they use when preparing the financial statement. For this, they show that they use straight line method for calculate the depreciation. Next, as you guys can see, this is the example if you don't know how to read the notes. For example, look at the property, plant and equipment. And then just imagine you want to know how they calculate the depreciation, So just look at the notes column and yep, boom, notes 10. So just find notes 10 at the notes part and then you got it. So very easy. So that's how notes to financial statement works. So that's all from me. Now you know what's the function of notes to the financial statement. Maybe you can do it later by yourself. Bye!